Meet Kevin interviewed Kevin O'Leary, Mr. Wonderful from Shark Tank, about several things involving the economy. He wanted to talk about cryptocurrencies, he wanted to talk about the stock market, and most importantly, he wanted to talk about real estate. Meet Kevin asked him some questions about HouseHack, the venture that he recently got off the ground and he's raised already $25 million for, and is starting to look at investing in single family residences, but is waiting for the housing crash. And he asked Kevin O'Leary about his thoughts on a housing crash, and it completely schooled not only Meet Kevin but also all of us into how to look at the real estate market. I'm Drew Page. Welcome to the Drew Page channel. In this video, we're going to break down the interview between Meet Kevin and Mr. Wonderful in regard to real estate. I'm going to put a link to the full video below so you see that I'm not taking anything out of context, and so that way Meet Kevin gets the proper attribution as well. If you find this video helpful, please subscribe to the channel, like the video, hit the notification bell. With that said, let's jump in.
You have roughly twice your typical sector allocation now allocated to real estate. You said 39%. Obviously, mortgage rates have increased from 2.5% in December to now on average over 7%, which is remarkable and potentially indicates that buyer purchasing power should go down by about 45%. Not necessarily to say that real estate prices would fall by that, but it does look like there is an inflection point. Housing prices have started to fall since about March to May. What's your take on how deep this correction can go? You've got, some folks screaming we've got a 50% coming, and then the counter argument is this is no 2008. Lending standards are too strong. Maybe we're in for a, average 15% correction. Where do you stand?
If you've seen my recent video on is there really going to be a housing crash, you know that I am probably in the second category of people that say it's probably going to be maybe a minor correction, 10 to 15% at the most. But I don't see a big housing crash. I don't see 40, 50% drops, in my opinion. Now, I'm not a financial advisor. I'm not a realtor. I'm not a real estate assessor. That's just my view. And if you want to know my reasons for that, go back and watch the video I did on is there really going to be a housing crash. But I was not sure what Kevin's answer, when I say Kevin, because they're both Kevin, I wasn't sure what Mr. Wonderful, Kevin O'Leary, was going to respond here with, but I actually made my video prior to this interview. For some reason I had some trouble uploading it, but I did actually record it before seeing this interview. And you always get nervous when you put out there, what your thoughts are on things, because people obviously may disagree with you and may explain why you're wrong. I haven't had anybody comment and tell me, anything about why I'm wrong as far as my video yet. But there's still time, and I'm not 100% convinced that I'm 100% right, because that would just be absurd. But I was very comforted in the interview that Kevin O'Leary gives. So let's hear what his response was to this and see whether he's on more of my view or more on the view of those who believe there's going to be a 40 to 50% correction.
We haven't seen a 15% correction in any markets yet. There's fundamental demand, obviously, and the consumer remains buoyant. But you're right, we could have that. Traditionally, the real estate cycle used to be 7 years. That has gone. We haven't had a significant correction. I don't care what market in North America you look at, for 25 years, and that's because of change in demographic and demand for housing, both rental and assumed ownership.
Now, obviously, I don't agree with that comment. There has clearly been a recession in 2008 and 2009 when the housing market fell in the Great Recession. And Meet Kevin later calls him out on that, and Kevin O'Leary does acknowledge that, and then he does give an explanation as to why he says that. It's not a great explanation, because he says it's only because it lasted for 18 months, but nevertheless, there was still a recession then. But his view is that there hasn't been even a 15% drop in any markets for real estate to this present point. And without that drop being demonstrated, he's still not necessarily negative or convinced that there's going to be a big drop in real estate prices as well. At least that's the way he's leaning. We'll listen to the rest of what he has to say, but at this point he doesn't see that there's even a 15% decline, even though, again, he forgot about the Great Recession somehow. I'm not sure how that happened, but let's keep hearing what he has to say.
But you gotta look at it this way. Real estate cycles are really interest rate sensitive, as you detailed. But these mortgage rates right now are still traditionally very low if you go over a 40, 50-year period. I've been an investor in real estate when interest rates are 15%, 1.5.
Mr. Wonderful says that he has had mortgages with a 15% interest rate, which in some places now is double, more than double what the current interest rates are in some states. I think Meet Kevin did a search a couple weeks ago, 2 or 3 weeks ago, or something like that, and there were already about 7% interest rates in California. But we're talking about more than double that. And Kevin O'Leary bought real estate with mortgages at 15%. And I kind of detailed this in a very quick 1-minute book review that I did on Creating Wealth by Robert Allen. And in that book, he talked about how he created $1 million worth of wealth during interest rate environments between 11% and 18%. And that's just insane for us to think about now. But he says over a 40-year period, it's really not that high. Even if we're at these levels historically over a 40-year period, we're still at low interest rates. We've just been so spoiled over the last, we'll say, 4 years where interest rates were, basically from like 1.5% to 2.5%, very, very minimal interest rates, and in many cases, a zero. So we've been spoiled, and that's what Mr. Wonderful is explaining to Meet Kevin and to all of us who are watching, is that really interest rates are not something that's necessarily going to make you or break you on investment prices. And so he'll continue on, and then Meet Kevin asks a really good question, and we'll talk about that.
I've been an investor when mortgage rates were under 4. And so at the end of the day, fundamental shelter and housing and office space and demand, industrial demand for real estate remains a constant in any economy at different levels of trajectory. But as an asset class, it has proven to be buoyant for hundreds of years. The old adage, they stopped making it a long time ago. Particularly that applies to beachfront properties and vacation properties. And look what's happened in Montana. Look what's happened in North Dakota. Look what's happened to farmland. These are all investments that I look at every day. Each of them have their own merits or risks. There's no question about it. But at the end of the day, it's a fundamental building block in anybody's portfolio. And the only decision you have to make when you're young is how much debt do I want to take on? And that's governed by the percentage of that mortgage. And so you're right. If mortgage rates go past 7%, and I think the terminal rate on the Fed will be under 5, so you could see some high-risk mortgages at 7. That's still traditionally not a very high mortgage rate.
So Kevin O'Leary says that real estate is an important staple in any real estate portfolio, and you know that I certainly agree with that. And he also says that even if the Fed terminal rate gets to 5, which would send home mortgages to 7%, that again, it's still historically low. And so when we're talking about the idea of investing property and maybe it's certainly going to price out those who can't afford the higher mortgage payments. So it's going to impact the poor and the middle class, the very ones who are currently in power, say they're here to protect, but that's where we're at. Those people may be priced out of certain abilities to purchase homes, but investors who are looking at things from a long term there's no reason not to invest in property, which is why I just recently bought a development myself, a 4 townhome development, 2 buildings, 4 units with the ability to build 10 more. It's got a paid parking lot and all these other things. I did a video on this about how Housing Noob, got into a $575,000 mistake. Check that out. But I've got that fully rented out. I mean, it took a week to get it fully occupied. So there's still money to be made even in high interest rate environments. So I wouldn't be scared off from investing in that. Again, that's just me. Everybody's different. I'm not your financial advisor. I'm just sharing with you what my perspective is on how I'm approaching real estate in this higher interest rate environment. And it sounds to me like Kevin O'Leary agrees with me.
Now, some would argue that, look, last time we had 15% mortgage rates, the median home price was maybe $80,000 to $120,000. Now we're sitting at $400,000, around 4 times that. do you think that we could be more sensitive because of these higher prices? And then also sort of a part two to that, you mentioned we haven't seen a significant correction in 25 years. What about '08?
Here, Meet Kevin addresses the thing that I talked about earlier, where he calls him out in 2008 about the recession that occurred there. So I'm not going to spend a lot of time on that. But the first question that Meet Kevin asks here is a great question. He says, "Well, what about the fact that when the higher interest rates were in place, the prices of homes were way down?" Whereas now interest rates are increasing, but prices are still high. Won't that have some impact on the stress and pressure of the market, which will ultimately bring those prices down? Now, my answer to that would be to look at wages at that time, and I'm sure that Meet Kevin's probably already looked at that as well. But we hear often about the lack of wage growth and how wage growth hasn't kept up with inflation, and how home prices have skyrocketed, but wages have remained pretty flat. But does that mean then that wages were more in line with higher mortgage interest rates back when the interest rates were higher and the median home prices were lower, so that they could still afford that payment because their wages were more commensurate with the mortgage payment? Whereas now, those who are at the lower end and lower middle class and at the lower income level, if you have higher interest on top of an already high price, you're basically priced out of a market. So I would look to wages, the wage comparison. And like I said, I'm sure that Mick Kevin probably already has it, saved on his Bloomberg terminal somewhere, and could, give an answer just like that. I don't know what the answer is, but that would be what I would look at. But let's hear what Kevin O'Leary has to say about this particular question.
That's true, but it was a very, very short period, 18 months. And so when you think about an asset class like real estate, it is a very slow turn asset class. The entry and exit fees are very high. You don't flip it, you don't trade it. You really have to think about the cap rate is reflecting. And what I would agree with your statement in '08 with the financial crisis was cap rates went up. And so it's the inverse. So if you buy a building at 4.5% cap rate, which was AAA office towers in Boston in '08, yeah, they spiked up a bit for that 18 months, but there were very few trades in that market. So, these assets people think very long term on. Now, I would agree there's a new reason to consider cap rates going up in industrial and commercial real estate. That's because of the new trend in work environments, which are not so focused on office anymore. For most companies now, they have flexibility, and up to a third or half of their employees never come back to the office. And that's probably permanent, particularly in sectors like technology. So that may put some pressure on cap rates for commercial, which means their values go down. If cap rates go up, the building's worth less. However, in the case of residential, the inverse is true, because all of a sudden you've got rural communities like Champaign, Urbana, and places where people want to live, raise their kids, go to good schools, get more house for the dollar. Those cap rates, or the cost of those houses, have gone up, and the cap rates have gone down, because all of a sudden you don't have to live in Chicago. You can live in Champaign, Urbana, and the lifestyle there on Greencroft Avenue, right on the golf course where I used to live a long time ago, that's a beautiful place to raise a family. And you can still participate in the Chicago community.
Mr. Wonderful gives his explanation about the recession piece, and like I said, that wasn't a great explanation. He just basically says, well, there weren't a lot of trades, and it only lasts 18 months, so it really shouldn't count. The truth is, he should have just said, I just misspoke. I forgot about that one. Other than that recession, there hasn't been a similar housing recession. Would have probably been better. But his answer to the other part, though, about the interest rate and the impact that it would have on home prices, he actually argues that unlike commercial and industrial, where the work from home and other aspects of businesses not needing as much real estate themselves has caused cap rates, which is where the value of the property is based on that percentage, and the higher the cap rate, the lower the value, and the lower the cap rate, the higher the value. He says that the commercial and industrial cap rates are increasing, which is bringing the values of those down. But In the single family and residential, he says the opposite is true. Prices are going up, cap rates are coming down. So, and he references Champaign versus Chicago, which also addresses what I mentioned in my last video about is there really a housing crash, that companies like Blackstone are ceasing single home purchases in certain cities, like big cities, like where there's regulation, like where there's circumstances that would keep them away from those particular areas. But they didn't say they were going to stop purchasing everywhere. And so this gives a perfect illustration of what I'm suggesting, is that there may be regional corrections, but not necessarily a nationwide recession on home prices. And so it sounds to me like Kevin O'Leary agrees with me. I would love to know what you think. Please put in the comments, do you agree that there's going to be a housing crash of 40 to 50% off home prices? Or do you think there may be just a mild correction across the board? Or do you think it's just going to be regional, that it's not necessarily going to impact all across the country? Let me know down in the comments. Again, thank you so much for watching. Please subscribe to the channel and like the video and hit the notification bell. And until next time, stay tuned.